Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Here's an attention getter. We're going to talk about the mother of all bear markets. What? Did he actually say that? Yes, Kevin Cook, our tactical trader here, to explain further. And you got some explaining to do on this one because you've been kind of bullish here.
I am still bullish, but we need to address the big bears out there.
All right,
Not just perma bears, but bears who are serious that, we've heard Dow 5000 for years. Well, let me step back to last week. I showed you this chart of the CAPE, which is the cyclically adjusted PE, sometimes called PE10 because it's a 10-year average and it's adjusted for inflation. And this is a bearish sign to some people that the CAPE is up here above 20 and the path of least resistance is a mean reversion lower.
Okay.
Well, this could still take years to unfold.
I see.
Well, this week we got word Zero Hedge. If you want to read anything bearish, you just go on Zero Hedge. Zero Hedge did a story about a gentleman named Napier, N-A-P-I-E-R, who is a fund manager that you don't often hear about, but apparently he gave a presentation a week or so ago in California to about 100 wealth managers, and he used this same argument that this is, stocks are overvalued and we are headed into a much bigger bear market. He's calling for S&P 450. That's, that would be the biggest decline we've seen. Maybe on a percentage basis, there have been bigger bear markets, of course, but we've seen in the past 20 years here, we've seen the S&P, well, just from 07, we saw the S&P go from, say, 1575 down to 675, 900 points off the top there. So to go from recent highs of 1470 down to 450 would be over 1,000 points in the S&P. I call that the mother of all bear markets right now in my lifetime.
But to be clear, this could take a while to achieve.
Absolutely. And there's a lot of other bears out there who've been called. Let's just look back at bears that we know. Peter Schiff of Euro Pacific Capital has been bearish for 5 years, and the market keeps going higher. And treasuries keep going higher. Gary Schilling, David Rosenberg, both very bearish, and these things take a while to play out for them. Obviously, let's look at another indicator on the chart that some people have been following. This is a monthly chart of the S&P 500 going back 15 years. So that's 1997. You see there on the left, and these are 50 and 200-month moving averages. Well, earlier this year, everybody was talking about the ultimate death cross. The 50 and 200-month moving average is crossing bearish. Well, they've kissed recently, but it doesn't mean that they're going to cross and we're going lower. And I said at the time, 6 months ago, that this could take another year to play out. And, we could still go higher. And the other thing people point out here is the head and shoulders top. That the all-time high in 07 is higher, obviously, than the 2000 high. Now we've made a lower high, so that's a head and shoulders top. Again, this could take years to play out. So here's in the short term, here's what some bears are looking at, that we've reached the top here. We're not getting through 1435 on the S&P, which is a key line in the short term and in the long term. A lot of people have 1435 as a level. We're not going to get through there, and we're headed back down to S&P 1300 in the next 2 to 3 months.
All right.
Now, how do I deal with the hyper bears? I tend not to think that far out. Like, I'm not looking at 15-year charts with a head and shoulders top or 50 and 200-month moving averages. And even if the CAPE PE, the PE10, shows that stocks are overvalued, again, that could take years for that to decline, and we could still we're still in a cyclical bull market that could continue to new highs. So, we've got this massive war of debt and deflation. And that's what Mr. Napier is looking at, is that our debt is going to crush us, and we're actually going to run into stagflation, where the economy and the markets plummet and bonds tank. I've actually had my money on the U.S. economy to continue to be resilient and central banks to prop them up.
Right.
You can't fight the Fed or the ECB right now, and the power of the printing press that they have will, I think, win the war against deflation. And we have to. Otherwise, a deflationary collapse like Japan's is unthinkable. So 3 reasons I'm not impressed with the big bear case. These guys draw out comparisons with the 1921 bear and the 1932 bear. Those aren't useful to me. We live in such a different age where there are so many drivers of economic growth because of technology and emerging markets that I don't think you can make the comparisons with 1921. Secondly, most people are familiar with the concept of survivorship bias. Some genius out there always wins. There's always the guy who shorted the housing market in 2007.
Yeah, right.
He won. John Paulson was one of those guys. Made his name. He's done nothing. He hasn't done much since. His fund is going to lose again this year, down 20%. And everybody wants to be the big bear and make that call, and I call it bear call bingo. And they want to be famous. So somebody's going to make that big dramatic call, but it doesn't mean it's going to happen. And for the S&P to progress into that kind of bear market would require a recession. So let me back up a second here. On this chart, this gentleman believes that the recession actually started in July of 2012. Well, if you listen to the Economic Cycle Research Institute, I can't even pronounce the gentleman's name, but he said we've been in a recession for over a year. So that's a key pivot here is if we go into recession, yes, stocks will easily be off 25, 30%. Will they be off 60%? Well, that would be a depressionary collapse. So, even if these guys are right with all the analysis, and we're talking, I've named 4 economists here who know a lot more than I do and can crunch the data better than I can. Even if they're right, this cyclical bull could continue for another 2 years before the market tops.
I see.
So that's my case.
Before that would set in.
Yeah, and we can adapt and still make money. Even if this unfolds in 2013, that we go into recession and the S&P's back down below 1,300.
Mm-hmm. Well, thank you so much for pointing out the holiday humbug out there. Kevin Cook is our tactical trader. You can read what he writes on our website, Zacks.com, if you're not there already watching this video. With Kevin, I'm Terry Ruffalo.